Okay, we are here talking about Silicon Valley Bank today. So, unless you've been living under a rock, you've probably seen the news that Silicon Valley Bank has collapsed. And we are talking about what that actually means. So, I have Jason Stebbins here. Thank you so much for being here, Jason.
Yeah, it's good to be back.
Yeah, so let's dive right into talking about what happened last week. And really, what I want to address is how this is affecting the real estate market. Of course, you're in lending, I'm in directly in real estate. So I want to figure out what this means for everyone from a very specific local perspective all the way to nationwide. So, talk me through your experience of what happened over the last week.
Yeah, so there's a lot of layers to this, both in the actual event itself, the fallout over the weekend, what's happened since then, and then of course how it correlates to our industry, mortgage rates, lending, real estate, that sort of thing. The bottom line is Silicon Valley Bank was not built like most traditional depositories. It was really high leverage on venture capital, technology. And as revenues started to shrink in those areas, they wanted to create some liquidity. They went to sell a pool of borrower based investments that they made when interest rates were not what they are now, and ultimately took a massive loss that in and of itself could be a problematic to any given bank who writes a $1.8 billion check to sell a pool of investments. But then in order to kind of shore things up, they had a massive stock sale that failed, and created a run. And then of course, the Fed coming in to shut them down. So because that happened on a Friday, it allowed for, the whole commentary and wild speculation of now what. But it also allowed a lot of data to be put out into the world about how many other banks were in the same position, where the leverage
Right.
that they had with investments has been impacted so much by rates going up, to the point that they could be in similar risk. Signature Bank on Monday, and a few others. So anyway, so that was the summary of the what happened, and it created, shockwaves. And the jobs report also came out on Friday, which was down, which those two things combined created a huge move in the mortgage rate
So
space.
let me pause you quickly, Jason.
Yeah,
So I'm going to go out and assume some people may not even know what a jobs report is. So
yeah,
can you define a little bit more about what that is?
yeah. So basically, every month there's statistical data that's released in all types of economic forums. Jobs report is particularly interesting when it comes to a Federal Reserve who's trying to curb inflation. And the jobs report was basically, the data that suggested that, the rate of hiring and the rate of jobs was decreasing. This was not the unemployment data; it was just stating that the new job creation had come down.
Okay.
Any data right now that is negative, economically speaking, is good for mortgage rates, from the perspective that the Fed's trying to stop the speeding train that is inflation. And by raising rates, these data points are the only place that they have to say, oh, look, it's working or it isn't working. So Friday, we had data that would suggest, okay, things are slowing down. And then we had the possible beginnings of domino effect bank failure. So Friday created some movement in the mortgage space that was positive, which tends to happen.
Okay. So all of that happening and what is your perspective of why this bank actually failed to begin with? So I've heard speculation, we've all heard and read these articles on what's been happening. So do you think this is an indicator of a bigger crash coming to our market?
Well, I let me tell you what I think. This is from the book.
Loaded question.
This
I
is
know.
from the book of Jason, right? So, um, I don't think our economic regulatory environment is such that they will tolerate a failure, and that's being evidenced already this week.
Right.
So we know that in the 2008 meltdown, there was a significant amount of government propping up the economy and bailouts and things like that. During the pandemic, we saw the government artificially suppress interest rates to try and stimulate activity in a very unique, traumatic environment for the economy. And now we have the beginnings of 2 or 3 significant bank failures, and immediately we have this new act, and I can't remember what it's called, but it's like the Bank Act or something, that's now designed to shore them up even over and above the FDIC insurance on accounts. So do I think we're going to see a systemic failure of banks? No. Do I think you're going to see problems inside of the boutique and massive, large-scale banking environment outside the too big to fail banks like Chase and Citibank and Wells Fargo? Probably. Yeah, I think you'll see consolidation, regulatory oversight. You'll start to see laws and bills passed that are directly regulating what these boutique style banks do with depositor funds, which is really what happened here. Is Silicon Valley Bank had so much money of their depositors tied up in investments that went sideways because rates went up, that if all those depositors says, give us our money, they did not have the money. And that's, so I think that kind of stuff is going to get regulated as a result of this.
Yeah. And I mean, as it happened in 2008, a lot of things were regulated that weren't regulated before, right?
Mm-hmm.
So there's lessons to be learned in any situation. The general public is not feeling the effect of this occurrence as much, of course, as they did in 2008. The questions that were popping up a lot on Friday were, how is this going to affect tech, right? With knowing the max payout from FDIC insurance, what that actually looked like. The big question was, are these companies going to be able to even meet payroll, right? $250,000 sounds like a lot to you and me, but when you're thinking from a company perspective, it's not a lot of money, especially on payroll day. So you have to look at it from that perspective. It sounds like everybody's getting their money back. Things are settling very quickly, which is a absolute positive. But it's the question of now, how is this going to potentially affect the real estate market? Which I want to share an article that I just happened to see here. So Zillow Research, which, I have my opinions on Zillow, but they have some of the greatest and most relevant articles pertaining to the real estate industry, which is what we're in. So they came out with an article really addressing my exact concerns as a realtor in Silicon Valley, right? So they talked about if it's going to be chilling out tech-dominated housing markets, which we are definitely in Silicon Valley. Obviously, we're at the core of this, and it may continue to bring down mortgage rates. So tell me, through the mortgage rate perspective, what you've seen over the last, we're not even in 7 days yet, over the last 6 days.
Well, on Thursday of last week, so 1 week ago today, the national average for 30-year fixed, according to National Mortgage News, was just under 7%, 6.99. Today it's 6.54. So the result is
big drop.
Yeah, obvious. And why is that is because, aside from the jobs report, aside from the fact that the core inflationary data that came out on Monday was negative, meaning inflation was coming down, so that's a positive for mortgage rates. That plus this banking collapse and what may need to be done in order to shore these banks up, and the pressure that the Fed has now to basically respond to the question of, did you raise rates so fast that you caused a national bank to fail? Those kind of things are all indicative that the Fed maybe has slowed the speeding train, that the speeding train, for as fast as it's going, is ultimately not that healthy inside of the engine compartment, and there's a lot of work to do. And
solid analogy, Jason.
Yeah, so I think that's why mortgage rates came down, was, the data would suggest that you are curbing inflation from the rate increases, and also that those rate increases may have adversely affected another sector of industry. And so you're going to stop it. You're going to stop with the increases. I don't know if that's the case. They were projected in this next meeting to raise the Fed funds rate from either 25 basis points to 50 basis points. Now there's speculation that it will be 25 basis points to zero. There's a possibility they may not. I don't think that they're okay with the optics of doing zero, but I do think you'll see a smaller than expected 25 basis point increase in the Fed funds rate. And I think you'll see them start to become more gentle in their language. And that is only good for rates. Now, for your side of the equation, you still don't have inventory.
Right.
So
it's a major issue right now.
Yeah. So you don't have inventory. You have a buyer demand to some degree. If interest rates drop another 0.5% to where we're at 6%, what will happen is you will unfreeze a huge component of buyer market who can now, affordability comes back to the table, and they're going after the same low number of homes as the ones who currently are qualified. So the question is, will enough sellers see rates come down enough for them to say, okay, it's okay for us to sell now because we can go buy something without too much of an impact on our budget or buy up.
Right.
The domino effect, I don't know what will happen yet, because the mortgage rate impact, I think, will be obvious. It's been obvious for a week. And as long as we don't see a continued economic data suggesting inflation is going up, it probably will stay this way or continue to come down. The question is home prices. I have a hard time finding out when those come down.
This is honestly the thing that I'm most nervous about. So people think that as a realtor, I'm nervous that the market's going to crash. No, I am focused on, of course, I want to see national news, but I want to know what's happening locally. And what's happening locally right now is exactly as you said. There are not enough homes. Inventory is the lowest, and I'm such a data nerd. I look back, lowest in at least 5 to 10 years, probably more, to be honest. I think it's just historical. And that is the biggest issue right now, because I have so many buyers that are even at the 6.8, 6.9% interest rate, they were ready to go. They just can't find a replacement property. And that's an issue, right? And this is continuing to happen. It's going to balloon up those prices again if it doesn't get under control. I was listening to a podcast the other day, and they had mentioned we don't need any more buyer incentives. We need seller incentives. This is a problem, right? Because every person that needs to sell a home typically needs to buy one too. They're not just selling a house, they're buying as well. And so the domino effect, as you referenced, this is problematic. And this is what scares me, because we have, anytime there's desperation in the market, either direction, right? It becomes really, really impactful on the real estate market. And it's not a healthy environment, even if it means, oh, well, there's not enough homes, so sellers can sell for whatever they want. That's not necessarily true. And it's not giving enough inventory for the buyers that are actively out there currently. That's the scary part for me.
Yeah, I mean, you're going to see, you'll see if interest rates continue to come down, you'll see a couple of things. You'll see a little bit of a spike in activity in the mortgage world, because the people who close their loans at 6.75 or 7% will have a refinance moment to be able to lower their payment. They'll take advantage of that. That doesn't really jumpstart much on the real estate side. But if you see another wave of, like you said, there's buyers out there trying to get into houses, and it's similar in some parts of the country. We have a unique microeconomy here because it's such a high demand place to be. So on that article you posted, the question is, will the tech side of the industries, that segment of industry, with layoffs, Meta just announced a 10,000 person layoff across all channels, as well as a freeze on hiring. So if you say, okay, well, is there going to be this domino effect of tech and venture capital and those types of industries downsizing? Will that create this environment in the Bay Area of lower prices because demand goes way down? And but you have so many other factors to that. Number one is they already qualified. If you were already in the house, then they qualified in a decade when it was harder than ever to buy a house from a qualification perspective. There's a tremendous amount of equity in the world. There is a tremendous amount of money in our industries in the Bay Area because people are sitting on RSUs and stock options. Those stock options are still valuable to them as an asset, even if they don't work there anymore.
Yeah.
And so, if I can replace 3/4 of my income, if I get laid off from my tech firm and stay in my house, chances are I'm not going to sell it either because I've got a lot of equity and I have a 3.5% interest rate. And what's the point? So, and then combine that with the question of, where am I going to go, and remote work and all these other things that are part of that. So I don't know how it'll affect our little microeconomy. I coach other loan officers across the country for a guild, and I talk to some loan officers in places like Arizona and Texas and the East Coast, Florida. It just depends, right? Some of them, central part of the state of Texas, they're still multiple offers. Dallas, Fort Worth, hot place to be. Austin, still super popular. Phoenix, especially downtown Phoenix proper. No, I bought my house and I was the only offer and the sellers gave me credit, so it just depends on inventory.
Completely.
But here we don't have it.
Right. So. Right. Well, and I think the last point that I'll really drive in, and I've said this many times before, but there's so many people here that are wishing for a crash. They're like, we want the prices to go down. And I'm going, you don't, because you may not even be able to buy a house if the market crashes. This isn't fairy tale land, right? We're not in a situation where magically interest rates are going to be low and prices are going to drop and the housing market the employment numbers are going to be great and all of these other things, right? So you can't have that unicorn situation. Our market is driven by the health of the economy here in tech and everything else, which is great. But at the same time, if those jobs all go away, then you can't buy a house anyway. So the idea of buying when it's affordable, well, that it's unfortunately not something that's probably going to happen here, right? Or it will happen one day with a lot of other issues tagging along with it.
Yeah.
So that's kind of my forever echo of a point that I want to make, is that no one wants a crash. Yeah. No one wants a housing market crash.
Well, timing the market is very difficult. So it's kind of like if you need a house and you want a house and you can afford the payment.
Yep.
With interest rate being the thing that can change. If interest rates go up, you've locked in the cost of your shelter for 30 years and you don't have to worry about being on the rental roller coaster. If rates go down, you have the ability to refinance and lower that interest rate. So interest rates are kind of the least of the concern, although it's the most often question we get as mortgage professionals, the first question many times. So if all of that is true and you can buy a place, I mean, there's families that I talk to right now that are doing home equity lines because their equity is so high in order to improve the home. They've been in that house for 15 years. That means 2 crashes they've been through, right? So they're like, but my house is still worth money and it still over time creates value. So it's part of your portfolio, part of your investment, part of your long-term strategy, the tax benefits, all the things we talk about. And so just be careful about trying to time it because, how can you? It's very, very difficult. And if it's a long-term strategy, now, if you're trying to flip it, then you better be more strategic, right? If you're trying to get in and out in 6 months or in and out in a year. But for most of us, we pick a house, we're in it for 5 to 7. That's the national average. So
exactly. Although investors are going nuts right now over housing. So it's like the same ones that are writing articles about the market coming to a halt are also throwing billions of dollars into the market in housing. So it's kind of, you got to pay attention to who you're listening to. But on that note, Jason, I really, really appreciate your time as always. If anyone's watching this and wants to know more about what's going on in this market, please do reach out. I appreciate your time, Jason, and I will see you soon.
Thank you. See you.